Good evening, and welcome to the AlgoIndex market close for Friday, July 10th. Here is the bottom line. A headline hit at 10:30 and knocked the S&P down 64 basis points in about 5 minutes. And by the closing bell, the index was sitting at its high of the day. That is the whole story of this market right now. And here is the part your screen did not show you. The recovery ran on roughly $7 billion of supportive dealer hedging flow at the index level, plus $4 billion more in single stocks. And the dip stopped almost exactly on a 50,000 lot dealer call position parked at 7,500. The S&P 500 closed at 7,575, up 0.42%, a 1-month closing high, with the NASDAQ 100 up about 0.4, NVDA up 4%, and the volatility index at 15. Coming up in the next few minutes, the 10:30 shakeout, and the exact level that caught it, which was not a random number. The options bet of the day, NVDA calls flagged in the morning that paid more than 1,500% by the close. The other side of that trade, a September S&P put position of roughly $1 billion, bought while the market closed at its high. And our own desk, which finished 1-1 on a whipsaw day. Here is the closing scoreboard. The S&P 500 settled at 7,575, up 0.42%, inside a 95 basis point range, low to high. The NASDAQ 100 added about 0.4, and the leadership was the mega caps. NVDA rose 4%, and SK Hynix jumped 13% on its NASDAQ debut. So the AI trade did the pulling. The volatility index closed at 15, and its own volatility gauge, VVIX, finished near 87, muted demand for volatility hedges into the weekend. Two numbers stand out under the surface. Options are cheap. Implied volatility is under 13 against realized near 15, an implied volatility rank of just 13%. And the put-to-call volume ratio printed 1.58, which is elevated. Cheap options plus busy put counters means hedging demand, not panic. So, what actually drove it? 3 things, each with a number. First, the shock. At about 10:30, a presidential social media post knocked the index down 64 basis points from the mid-7,550s to 7,508 inside 5 minutes. Second, and this is the part you could not see, the flow that bought it back. Index-level dealer hedging flow ran about positive $7 billion on the session, roughly $4 billion of it from put selling, mostly same-day contracts, plus $3 billion of call buying. That put selling did double duty. It supported price, and it pushed implied volatility lower. On top of that, single stocks drew about $4 billion of positive flow, led by longer-dated call buying in the megacaps. Real positioning into next week's earnings, not day trades. Third, the structure. The fall stopped at 7,508 because just below it sits 7,500, the market's largest gamma concentration strike, where a 50,000 lot dealer long call position acted as a buy shelf all day. Now the tell under the surface. 1-month implied correlation closed at 3.44, its lowest level in the past year. Stocks are moving independently, the index feels calm, and that same compression is the fuel for a sudden air pocket if positioning shifts around next week's data. Now the levels walked against the real session. The S&P opened near 7,548 and drifted higher until the 10:30 headline hit. The flush bottomed at 7,508, 8 points above the 7,500 shelf. The gamma concentration strike with that 50,000 lot dealer call position, and the bid returned within 10 minutes. From there, the afternoon was a steady grind. The session high, 7,580, printed at 355, and the index settled at 7,575, right on a 99% magnet strike at 7,574. Context for the ceiling. The options market priced today's implied high at 7,595, and the gamma ceiling above sits at 7,600, which is also marked as the major resistance into next week. So the map is clean. 7,500, then 7,450, and 7,400 are the support ladder. 7,440 is the pivot that flips the whole environment, and overhead, it is 7,575. The implied high near 7,595, and the big wall at 7,600. Here is where the real money went, and it is a two-sided story. The bullish side was NVDA, and it was flagged before it paid. The morning flow report highlighted 2 block spot to open, 21,000 same-day 210 calls at 6 cents, and 20,000 July 24th 205 calls at $5. By the close, the same-day calls were worth $1, up more than 1,500%, and the 205s had doubled. NVDA broke through its 205 gamma ceiling with about $1.7 billion of positive hedging flow behind it, and its options traded 5.5 million contracts, more than S&P index options themselves. But the hedges were just as loud. The single largest premium print of the day was a September S&P put position. 15,200 contracts struck about 7% below the market, roughly $1 billion of downside insurance bought, while the index closed at its high. Add about 56,000 small-cap ETF puts into monthly expiration, and the barbell is clear. Chase the AI upside in single names, and quietly pay up for index protection into the inflation print. One more read for the options traders. Implied volatility is objectively cheap, under 13 implied against about 15 realized, an implied volatility rank of 13, and single-digit short-dated index volatility stretching out roughly 2 weeks. Skew is only mildly bid for downside. The 25 delta risk reversal is barely negative. Meanwhile, volatility index traders spent the day selling premium on both sides into November. About 60,000 puts and 90,000 far out of the money calls. A bet that volatility stays boxed in. The actionable line, with correlation at a 1-year low and protection this cheap, downside insurance into Tuesday's inflation print costs less than it has in months. Our end-of-day options read leans the same way. Longer-dated put protection into next week is the trade that makes sense while it is still on sale. And here is our desk, the honest version. Our systems traded 3 times on a whipsaw day and finished 1-1. The win, a NASDAQ side call that rode the recovery and hit its first target just after noon. The loss, an S&P put that was right about the morning shock but got run over by the afternoon melt-up and was closed at the session cutoff. The third setup armed but never executed after a maintenance restart, so no risk was taken. Every entry was single leg with defined risk, and the losing trade was cut by rule, not by hope. On a day that reversed 70 points off the low, that discipline is the whole game. Into Monday and next week, our bias is bullish with medium confidence, and here is the reasoning. Price closed at the session high, above every support that matters. Dip buyers prove they show up within minutes, and momentum still is not stretched. The index sits 0.6% under its record at 7,621, with the overbought line far above, near 7,771. The price map, gravity overhead sits at the magnet strikes, 7,596, at nearly a 100% node, right where the options market already priced the daily high. And then, the 7,600 wall, the marked major resistance for next week. Support is 7,550, then the 7,500 shelf. The risk is all calendar. The inflation print Tuesday the 14th, producer prices and the first big bank earnings Wednesday the 15th, and monthly options expiration Friday the 17th. That expiration matters because positions reset, and with correlation at a 1-year low, that reset is the air pocket window to respect. What would flip the bias? A sustained loss of the pivot near 7,440, which turns dealer hedging from stabilizing to amplifying. That is your market close for Friday, July 10th. If this helped, the best next step is our free AI trading journal at members.algoindex.com. Check our gamma level accuracy tool and the full write-ups on the blog at algoindex.com, and join the community on Discord. Have a great weekend. Trade well and stay disciplined.